I want to give you one more case study on today's episode. We'll call him Tom. And by the way, this case study comes from Rescue Your Retirement by Pamela Yellen. If you'd like a copy of the entire book, Rescue Your Retirement, to see all the numbers, again, schedule a call with us. Make sure to write the words Rescue Your Retirement Book in the notes of your appointment. Just go to our website, notyouraverageFinancialPodcast.com, and click on Request a Meeting. And again, write the words Rescue Your Retirement in the agenda of the appointment, and I'll know to send you a copy of the book. Now, on to Tom's story. Tom Justice is a 59-year-old chemical engineer who has three major concerns about his retirement. First concern, he's really concerned about outliving his retirement savings. He's read the statistics. He knows that in spite of experiencing long bull markets throughout the 2010s and up through 2020, he knows that the average 65-year-old will still outlive their savings by almost a full decade, according to the World Economic Forum. Tom doesn't have anywhere near the amount of savings recommended by many experts. According to the rule of 25, you got to have about 25 times your annual expenses saved by the time you retire if you don't want to run out of money. Tom also wants to live on at least $100,000 a year, which means he'd need at least $2.5 million saved up. And that's a far cry from the $750,000 he's managed to scratch together in a taxable 401k. All of that money invested in the market, and he knows it's past due for another major market crash. So that's his first concern, outliving retirement savings. Second concern is Tom believes his tax rates will only go up over the long term. He's worried that a big tax increase over the long term will take more money and sacrifice more cash in his taxable 401k. He's beginning to realize that he doesn't have a tax-free retirement. He's only postponed the taxes due in that 401k. Much like putting off a visit to the dentist, he's only making the situation that much worse. Tom realizes that he could easily fork over 30 to 50% of his 401k money to the IRS due to his tax bracket. Tom's third concern is something called required minimum distributions, where he'll have to start taking money out of his 401k in his early 70s. Tom's CPA warned him that seniors are finding themselves in the highest tax bracket of their lives once they have to start taking required minimum distributions, or RMDs. And the idea that he'll also have to pay taxes on his Social Security makes him really mad. It just doesn't seem fair to Tom. Tom loves his career. He wants to continue working as long as he can. He was relieved when his Bank on Yourself professional proposed a creative solution to all three of these concerns based on his goals, based on his objectives. How do we solve Tom's three big concerns? Tom could roll his 401k balance into a fixed indexed IRA annuity with a guaranteed lifetime income rider. Tom could take annual withdrawals from his annuity out of the IRA and use that money to fund a Bank on Yourself type high cash value dividend paying whole life insurance policy. Doing this would reduce his RMD problem, required minimum distributions. It would also get the money out of a taxable IRA and into an after-tax and potentially tax-free life insurance policy, alleviating a future tax burden. Tom also will create for himself in the annuity an income stream he will not be able to outlive. So here's the solution that solves all three of Tom's concerns. And there's 8 steps here, so hold on with me. But step 1, Tom transfers $750,000 in his 401k into an IRA fixed index annuity. This is a tax-deferred move. No tax is due to make that transfer. It's simply an IRA rollover. Step 2, the following year, Tom activates the increasing income rider feature on his annuity and starts to take $34,700 of income that year alone. With the rider on his annuity, Tom has the ability to increase his income on that annuity every year over time. With the rider on his annuity, Tom could have income for the rest of his life and even pay raises over his lifetime. Each increase that he receives will be locked in. The income he receives from his annuity will never go down. So that's step 2. Step 3, Tom pays 25% of first year's withdrawal of $34,700 out of his fixed index annuity IRA. After taxes are paid, he's left with $26,000. Tom is still working as he planned. He doesn't need that 26 grand to live on for groceries, so he uses that money to fund his first year premium for a bank on yourself type whole life policy. Step 4, the policy he purchases is called a 10-pay policy, meaning that after 10 years, no more premiums are required. These policies make great sense for anybody with a relatively short timeline to reach a financial goal, or who doesn't want to be committed to paying premiums beyond a 10-year window. People often start these policies in their late 50s or even early 60s or even older because you're rarely too old to benefit from a whole life policy. Step 5, Tom funds his policy for 10 years with income he takes each year from his annuity, and no more premiums are due after the 10th year. So now when Tom turns 70 years old, he could start taking an additional $15,000 a year from his whole life policy until he's 100 years old, with no taxes due under current law. Step 7, due to the increasing income rider on Tom's annuity, the income he's taking has grown now to $58,000 a year by the time he's 70 years old. And when you add the 15 grand a year from his bank on yourself type policy, that income could be $73,000 a year. Plus, he'd have Social Security, and the income he takes from his policy does not subject him to taxation on his Social Security. That's awesome. That's like taking a 10% of his original contribution out each year. That's a far cry from the 3% withdrawal rate Wall Street recommends for their products, and they don't have any guarantee, even on that paltry 3%, that it'll work out. So he started with $750,000 in an IRA. Now he's taking out $73,000 a year total from the IRA and the whole life policy. That's almost 10% a year. Step 8, Tom could enjoy an increasing income from his annuity even if he lives to age 105 or even beyond, which gives him peace of mind, gives his family peace of mind. So what's the bottom line? By age 96, Tom could receive a total of $3.9 million. That's almost $4 million. This is $2.5 million more than he would have received had he left his money in a 401k, conservatively invested, earning 5% a year. You know, since he's close to retirement, most people would tell him to avoid aggressive investments. He would have been paying typical management fees. He would have had to be forced to take required minimum distributions out of his account every year and paying taxes on those withdrawals. Tom can now sink his teeth into a juicy retirement knowing that he no longer has to worry about required minimum distributions pushing him into a higher tax bracket or worry about next year's market crash. I can promise you that your situation, guys, is going to be different from Tom's, but it's a great case study for what's possible. You may be older or younger than Tom was when he got started at age 59. You might have a lot more or a lot less saved for your retirement. You may make a lot more, a lot less money. You may have a special needs child. You might have an aging parent to support. Literally hundreds of factors are taken into consideration every time I sit down one-on-one in an advisory role with our clients. So no two financial strategies are alike. And the most important numbers in this case study weren't even discussed. Your numbers are more important than any case study, and that's where it really takes us sitting down to have a conversation. This is a moment where you can make the most. He had $750,000. We were able to generate over almost $4 million over his retirement years. So reach out to me and let's schedule a call. Go to notyouraverageFinancialPodcast.com and click request a meeting. So guys, thank you very much for today's episode. Get on our mailing list if you'd like to just be in touch and learn about all the things that we're up to with Not Your Average Financial Podcast. We get our episodes out to you each week so you don't miss any of the amazing free content that we're pumping out on YouTube and on the podcast. We also give access to exclusive free live calls, office hours, Q&A with me and other advisors. So definitely go to notyouravagefinancialpodcast.com and click subscribe to be included in our community. And thank you all for joining me for another episode of Not Your Average Financial Podcast, helping you think different about your money, your economy, and your future.